But the difference with getting rich or getting wealthy in the bike ride is the bike ride can happen over 1 year that you accomplish this unbelievable milestone. Accumulating enough wealth takes a decade or 2 decades or 3 decades. It's a much longer process. However, the steps are the same.
Welcome to the Active Advisor Podcast, brought to you by Harbor Capital. Join us as we learn from pros who have helped thousands of investors live better lives. I'm Bryan Moore, and I'll be chatting with some of the brightest minds in the financial advisory business, bringing you insights on practice management and investment research that works for advisors and their clients. Joining me today on this episode of the Active Advisor Podcast is James Studinger. James is a true Yooper, whose outdoor adventures in Michigan's Upper Peninsula have shaped his approach to financial advising. From hiking across the UP to conquering Ironman races and climbing Mount Rainier, James believes in meticulous planning, balanced strategy, and a relentless pursuit of excellence. Please join us as we explore how James's outdoor ethos translates into his principles for financial success. Welcome, James, and thank you for joining us.
Thank you. I appreciate you having me on.
Now, in case any of our listeners are scratching their heads at the term Yooper, that just means that you grew up in Michigan's Upper Peninsula, right?
That's correct. So a lot of times when people think of Michigan, they put their hand up, the Mitten State, and the UP is what's above that.
Beautiful country, if I remember correctly. I lived in Chicago for many years, and we'd go up there, or I'd go up there, to travel around, especially during the summers.
A lot of people think it's part of Canada, and Yoopers get real upset when they see a national advertisement from XYZ company, and they have it on like the USA Today or some advertisement, and the UP is omitted from the country map.
Yep, no, that's got to be kind of a kick in the teeth a little bit, with no doubt. I'm going to try something new today. Hopefully you can, you're a willing participant here. I'd love to hear in your own words, if you wouldn't mind giving us a 30-second professional introduction on yourself.
I am a wealth manager and a financial planner, and I have an office in Bloomfield Hills, Michigan. And it's a small office. We're an independent firm. We clear through Kestra. And we've been in business. So I think I've been doing this for almost 30 years. I don't know exactly, but it seems like it's been a long time.
Well, when you're having fun, the years just go by. That's awesome. Thank you so much for doing that. I appreciate it. So typically here on the Active Advisor, we like to get the conversation started by asking each of our guests, what's the first memory you have related to money or investing?
Okay, so came out of the UP in 1990, went down to college in Lower Michigan, downstate. And if you remember back in the 80s, and if you can think about a small town up in the Upper Peninsula, we weren't exposed to a whole lot of things. We had the Brady Bunch and Gilligan's Island, and there's no internet. And, I'd read different magazines once in a while, but it was really a different world. I came downstate and went to the student lounge one day, and Discover Card was having I don't know what you call it, an expo on their credit cards. I had actually never even seen a credit card before. I was surprised at how easily they signed me up. I thought this was amazing. I had a $2,000 limit. And I don't think it's a coincidence, but right outside of the student lounge, as soon as I had my brand new fresh Discover Card, there was a rollerblade company, Bauer, was selling rollerblades, and they had just come out. I played hockey my whole life. I had never actually seen a rollerblade before, and so I bought immediately my first purchase, a pair of rollerblades. I maxed out that credit card. I made all the mistakes people do make, but I kept the rollerblades. I still have them to this day as a reminder about that early mistake with money.
Well, that's awesome. And Bauer, just for those who don't know, has been a big time hockey equipment manufacturer. So I'm sure they knew what they were doing.
They knew what they were doing. So did Discover Card.
Yep. Well, that is probably, I'm going to give it to you, James. That's probably the best memory. I think, definitely kind of more humorous, but that is one of the best memories I think I've heard when we've asked that question.
Well, it made a huge lasting impression on me. I didn't do a great job with money in college. I didn't have any experience with it. I had student loan debt. I maxed out the credit card. That didn't take me very long to do. I always worked through college, but I wasn't making great decisions. And one day on a wall at one of the office buildings, there was an advertisement for an internship at a financial planning firm. And I thought, I'm going to go do this. and see what I'm, maybe I'll learn through osmosis or, learn
Yeah.
what I'm doing wrong. And this shouldn't be so difficult. I didn't think, having money or dealing with your money would be such a difficult thing. And so it was really that experience that got me into this business. And if I hadn't had that experience, if I hadn't made those mistakes, I have no idea what I'd be doing today.
Very interesting because that's exactly where I was going to kind of transition to. Love to. You've got this background. You definitely have this what seems like a seminal moment for you early on in your college career, and then obviously you had the internship, which kind of taught you a little bit more financial responsibility and kind of how people are planning and long term objectives. Was there anything from those two? Kind of what was the springboard from that second experience, I guess, at the financial planning firm that led you to founding your own practice?
I mean, I really fell in love with the concept of financial planning and investing money. I was very much intrigued by it through that job. And so I did figure out that this is a career path that I want to take. I think the main thing was that I had made so many mistakes at that very young age, and I wanted to have a good relationship with money. And then once I understood the basics around it, it's really not that complicated. And so it has really driven, I guess, probably why I'm an independent advisor today is because I've been driven by education this whole time. Like I do what I can, I write, I speak when I can. I guess I view myself more as an educator than a financial planner. It's always been the leading drive for me in my career is to educate people to have a really good relationship with money. It's not that complicated, but we make it really tough sometimes.
Well, it's some of life's better lessons can be on the tougher side. We touched on it briefly in the intro, but from what I'm able to gather, you're quite the outdoorsman. I'd love to hear if you, in your opinion, think there's any correlation between these outdoor activities and athletics and building wealth.
There are a lot. I noticed in training for triathlons that when I started running and you start biking, you start swimming, you're always paying attention to your metrics. And these metrics, like, what is my mile, how many minute miles am I doing on my run? And if I'm training for a longer event, then I'm measuring a different metric than if I'm trying to do really well at a 5K. And then in 2018, I think this is an interesting correlation. In 2018, I started this bike ride around the Upper Peninsula called Tour de Yoop. And it's a 1,200-mile, 10-day ride around Michigan's Upper Peninsula. And I started it just simply because I wanted to showcase safe biking up there. There's like no bike accidents up in the UP compared to elsewhere. And one of the big risks in triathlon is not getting hit by a car while you're training on your bike. So that was really my intent. But what I have learned a lot from that, and I'm just going to give you a quick example because this does correlate directly to how you build wealth. So people, they decide they want to do this ride, and it's 1,200 miles, it's the same distance as from Detroit to Disney World. It's a long stretch. And they can get started. Anybody can get started in March, April, May, and you can get fit enough to be able to do this ride by the end of July. And I've seen it over and over again with people that show up. Not everybody that shows up, actually, probably half of them are like big time riders. Most of them just saw something and they wanted to take on this big challenge. So what you have to do is ride your bike more often than most people ride their bike. You have to train a little bit more often than most people exercise or train. And it's very important to be consistent. And it's also very important to not overdo it. If you overdo exercising or training, you're run down and you're tired and you're grumpy and you're sore and you're getting hurt and you have to take time off. And that's not very productive or a balanced life. And then you show up to this event ready. And along the way, you've learned how to eat, how to drink enough water, how to get the electrolytes. So like you learn some of these details along the way to make things better and put things more in your favor of success. Then you show up, you're all ready for this thing. You don't know exactly what you just got yourself into, but you show up. You do the first day, you do the second day, you're with other people that are doing their first day and their second day. And you're crying sometimes out of joy. Sometimes you're in pain. Sometimes you're tired. Then you see yourself getting stronger and you're climbing hills faster than you ever did. And you're already 600 miles in for the week. And you're thinking, how in the world did I just do that? And all of a sudden, 10 days go by and you've accomplished this unbelievable feat And if you were to categorize yourself, you'd be some of the fittest people in the world. I don't know what percentage you would be, but you've just done something more than what most people in the world have ever done. And you did the whole thing over the course of a year, and you really did that amazing milestone over the course of 10 days. And when I look at all of these steps that it takes to get ready for a bike ride like this and to accomplish it, those are the same types of things that happen with money. So you just have to save money more often than you did before or than most people do. And you have to be consistent with it. And you don't try to time things. And along the way, you get better and you get better advice, maybe, or you discover better tools or better resources. But the difference with getting rich or getting wealthy in the bike ride is the bike ride can happen over 1 year that you accomplish this unbelievable milestone. Accumulating enough wealth takes a decade or 2 decades or 3 decades. It's a much longer process. However, the steps are the same. And so I see with exercising or some event, it can give people the courage and the discipline and the tools that they need to stick with their same process of what they do to get rich or to get some level of wealth that they desire. So I think there's a real direct correlation with it.
That's awesome. And as somebody who's kind of personally going through that journey, not training for anything in particular, but it's definitely, I can attest and totally agree with what you just said regarding that you have to have kind of, you're going to go through all the emotional ups and downs and physical ups and downs, but you definitely have to have a process, a philosophy, and kind of a behavior that's built around kind of achieving a goal, whether it be
Exactly.
financial, readiness or kind of, completing the objective, whether it be race, triathlon, or whatever. So that's definitely got to be a part of your, I guess, mainstay and just in life, period. Not only personal life, but also kind of your professional life. Would love to hear a little bit more about that kind of, because it's in reading your book briefly, spoke earlier this week. And so I've had a chance to kind of, start perusing a couple of pages. You touch on a concept that you like to call the big three principles. Love to hear a little bit more about how does practicing these right behaviors correlate to creating and maintaining wealth?
So in the book, I break out 17 principles that I think are important to understand in accumulating wealth. But I find myself talking about three of them almost all the time. And so I call them the big three. And the main principle is that I break all money, all assets down as either a good asset or a bad asset. I keep it very simple. And good assets are things that you purchase that you intend to get richer with, or you intend to convert into income in the future. And a bad asset is everything else. There's nothing in between. It's either something that can make you richer or it's something that makes you poorer. A bad asset depreciates in value or costs money to maintain. So whether that be a car, whether that be a house, whether that be clothes that need to get dry cleaned, whether that's food that you buy, there's some necessity purchases that we have to make. But the bottom line is every single one of those things make us poorer. If I get paid $1, I have a decision. I can take that dollar and I can buy something that makes me richer. That's buying a good asset. Or I can buy something that makes me poorer, and that's buying a bad asset. And immediately that dollar is worth less than it was before. So that's the first principle, is just acknowledging that reality. And I do talk about wealth as something that we buy. I try to make it very tangible. It doesn't like flow out of the sky or something, you know what I mean? We physically buy wealth throughout our career. And depending on how much wealth we purchase, that will determine how wealthy we are at some point later on in life. It's our decision to buy it. So that's the first one. The second thing is having this recognition of what I call offense and defense with money and financial decisions. Offense is our money that comes in. Defense is what we do with it. And I have always found that having a concentration on defense is more important than thinking offense is going to solve all your problems. A lot of times you have a conversation with somebody and they maybe struggling to get ahead or save as much money as they want to save, then they always think, I need to make more, I need to make more, I need to make more. But until you have a really strong defense, no amount of offense will be used efficiently. If I make $10,000 more next year than I made last year, and I haven't figured out how to do the best out of what I already made, I'm not going to realize that whole $10,000. I'm only going to realize a small portion of it because all of my inefficiencies and all of my mistakes and all of my problems, they get magnified as I make more money. And so the first focus is always mastering a really strong defense. And then you can pursue more offense. It's always good. But the first step is always defense. And then the third principle is that we earn an income by solving problems. And I like to reflect on that as my job. Like if I'm not solving somebody's problem, I'm going to be out of a job. And I think that's the greatest job security that anybody has is we should always go at our job with a mindset that I need to solve problems in order to earn an income.
I've never heard it broken down that way, but I actually really, that's something that relates to me. And I definitely can kind of, I find that very relatable, I guess is just the best way of putting it. That's, you're right. I think that is one of the things that we all do. And I definitely love the defensive aspect of money because you're right. If you, without a good defense, it doesn't matter. You're constantly on a treadmill playing a game that basically you can never run fast enough.
Yeah. I think we've all seen people with a very high income and technically a very small net worth or technically a small good asset side of the equation anyways. Income does not determine how much wealth somebody's going to have. I haven't seen that at all. I think what you do with your income, that is going to determine where you end up.
We'd love to hear real quick. What is your thought on something like housing? I mean, I think that's something that when you go into it as a homeowner myself, you kind of go into it, you're like, "Whoa, big purchase." Definitely, definitely can kind of, you're like, "This is a bad asset, make money off of it." But one of the things that's been crazy these past, I'd say decade plus, is that people, we're having these pockets of bubbles, definitely during COVID, where you're seeing people, capitalize on that.
Yeah. So that was interesting because I wrote the book back in like '07. So people were reading it before the financial crisis, and I listed a house as a bad asset. And then I got a lot of pushback on that because we remember back then homes went from 300 grand to 500 grand to 700 grand. Like, I'm making money on my house. I don't know about you, but they are tremendously expensive to keep up. I mean, it is what it is. They're a depreciating asset in terms of that we constantly have to put money into it. But it's like food. It's one of those things. We always need a place to live. That's something you got to solve for in life. And so I like owning a home, and I'd like to not have debt on that home at some point, and therefore be able to minimize what it costs for me to have a place to live at some point in my life. And so if I rent throughout my entire life, then I'm never going to like capture that strategy. I'm not going to have all this upkeep, but I will constantly be at the mercy of whatever rent, market payments are at that time. So I'm a big fan of owning the house. I'm a big fan of paying it off at some point in time. And everybody that lived through the last decade of low interest rates, I mean, that's just we were delivered a gift, a gold mine that I don't think we should ever expect would come back again. For younger people, I wish they'd get to experience it once. But it's an unbelievable period of time for us to own our homes, pay them off, and pay hardly any interest at all. And then maybe we move again, but we don't move with debt as much. We move with the equity that was in our house that we were able to actually own.
No, that's an excellent point. So with all that in mind, and sorry to throw you the curveball there about housing, but I think that's one of the things that really intrigued me about this, business we call financial planning and the financial, system is that things change, but that doesn't mean that the principle has to change. It just means that kind of the way the way you look at it and the way you're factoring it and working with it changes. So speaking of changes in financial planning, JPS Money is your process in your firm's process on how you refer to the financial planning. What does that consist of, and how does this approach allow you to differentiate yourself from other advisors?
So we use a platform that allows whatever I see in my financial planning software and work that I'm doing, the client logs in and they can see the same thing. So it's a very open architecture platform where accounts can be linked to it. They can be manually inputted if necessary. And then when I'm doing work, we can be on a Zoom call together or a phone call together, and we're working together. So casework can be a flowing back and forth sharing of ideas and thoughts. So that's the platform. The process is that no matter when I start working with somebody in November, December, we're working real hard on their site, their system to make sure that everything is up to date and everything's accurate. In January, we're doing a lot of casework in the office for all of our financial planning clients. I come in sweatpants a lot and t-shirts and, because I'm not seeing anybody, I'm just doing casework. But we're looking at everything that happened last year, what their net worth was last January, what their net worth is now this January, and their good asset number, what we expect their net worth will be 12 months from now based on what their behaviors are and what we think that they're going to get done this year. And then everything that needs to get done this year to get them to that number. And maybe it's kind of like that bike ride thing where, if you've got a goal that's 20 years away, it's a lot harder to stay true to it. If you have a goal that you're constantly making 12 months, it's a lot easier to get the things done that you need to get done. So we'll have a marching orders for the coming year, and then we meet throughout the year to see how we're progressing toward those goals and milestones that we're all working toward. So that's the process. To me, financial planning, whether you do something like that or whether you're keeping track of it yourself on an Excel spreadsheet, it needs to be done. I'm a true believer in knowing your numbers. I think that's honesty. When you know your numbers, good or bad, great, or, you wish they were better, it doesn't matter at all. What matters is that you know what they are. That's the honest reality. And then you have some real data that you can start to make good choices from. And if you don't know your numbers, you might think you have an idea in your head, but if they're not down on some program, you don't really know them, and you can't really make great decisions then, and you're just not going to be as wealthy as you could have been.
Well, no, excellent points. And I think it dovetails very nicely into what I was going to ask you, what I was thinking about asking you next. Obviously, knowing your numbers, kind of having a plan. One of the things that you've mentioned previously is that you're frequently talking to clients about the differences between pre-tax and 401k Roth savings. And this really comes down to knowing your numbers and knowing how that plan is going to play out. I'd love to hear some more thoughts on this and why you're having these conversations.
I think saving into the Roth is the biggest paradigm shift that hasn't happened yet financially in our country. I think what we work at a place and we jump into the 401k or the 403b, and we automatically sign up for the pre-tax contribution, where if I make, X amount of dollars and I put $500 into my 401k, it goes away pre-tax, reduces my taxable income. I pay a little bit less of a tax bill that year. I set that money aside. It grows later on when I retire. That's taxable income for my future. And I grew up doing it that way because a Roth, that was the only way. I mean, a Roth wasn't available inside of 401k. A Roth is available in a 401k now. And I have seen very, very few people on their own make that change, log in to their 401k, go to my contribution, uncheck pre-tax, and check Roth. I've seen very few people make that change. And to me, the pre-tax, again, it was the only option, but it never made any sense. I think the idea of saving pre-tax and saying that this is a good idea for you is assuming that we're going to fail at becoming wealthy people. Because if you think about even, if I'm going to contribute my income into a 401k over 20 or 30 years, and I think my benefit is to get a pre-tax deduction today, like that's my benefit. I'm assuming I'm not going to have very much money when I'm 60 years old. I'm assuming I'm going to fail, honestly. If I think that getting a pre-tax deduction is better than getting no deduction, paying my tax now, and accumulating millions of dollars for retirement. Because I would rather take millions of dollars outside of a 401k and never pay taxes on that than have received maybe $100,000 or $150,000 tax break over the course of my career. I mean, that math doesn't make sense. But back when it started, back in the 80s, when 401ks came around, that was all we had. And when I got in the business in the 90s, I remember the conversation was that take your tax break today, you're going to be in a higher bracket. Later on in retirement, you're going to be in a lower bracket. So for one thing, I don't think that that's true, because people that do it right, they accumulate a lot of money and they will live very close to how they lived when they were working. I'm not seeing people that did it right fall to a lower bracket. I don't think that that's an assumption we should all make. Secondly, right now in our country, we have the worst fiscal balance sheet in the history of our country. Our debt to GDP is higher than it's ever been. It's even higher than it was after World War II. And we have some of the lowest tax rates that we've had since the Great Depression. We were talking earlier about mortgages. We got mortgages at 2%, 1.8, 3.2, and now they're 7 or 8%. And people think that that's astronomically awful, but that's normal. They were 6, 7, 8. I remember when they broke 6%, actually. They hadn't done that in my lifetime. They were 7, 8, 9, 10%. That was normal. 2%, 3% is not normal. The tax rates that we have right now, they're not normal. They're the lowest they've been since the Great Depression, basically. After World War II, when we had debt to GDP over 100%, like we have today, but it's even worse today, we had decades of ultra high tax rates because financial imbalance takes a lot of money to fix. And so it's just math. And unlike World War II, where we're getting over a very expensive war, we're not getting over anything right now. We have more people retiring. We have more obligations. We're spending more on military, not less. We have more money going to Social Security or paying out to Social Security. We have more money on our debt. Our debt payment is close to $1 trillion right now. So none of these expenses suddenly are going to get less. They're all getting more. So number one, I think the math never made sense, even if we weren't in a bad fiscal situation, but we are in a bad fiscal situation. And so I think our tax rates will probably be higher in the future. So from all aspects, I'm all in on the Roth.
Well, it definitely makes sense, and especially when you start factoring in those higher tax rates. And you're right; they at some point in time they have to come. So it's definitely one of those things where you see it play out. And it's funny. I was talking to somebody else the other day, and they're like, another advisor mentioned when my clients want to know when we're going to see 3% interest rates again for our 30-year fix, and I'm like. Yeah. Probably not in their lifetime. Just so we're all on the same page. Like I'm just going to be the bearer of bad news and be like, probably never again, because that was, we've had two anomalies, I think, in the past 15 plus years between the great financial crisis and then COVID. And so at some point in time, you're right. You have to pay for that.
The way so Roth conversions come up a lot. People ask, should I convert a pre-tax account into a Roth account? And the way I visualize a pre-tax account and even a non-qualified account versus a Roth is in a pre-tax account, you have a business partner as part of that entity. So if I have $1 million and I have a pre-tax, 401k, I don't own $1 million. I own a portion of that. My business partner owns part of it. Then my business partner gets to decide what amount they own because they dictate what tax rates are. So they might own 30%, they might own 35%, they might own 22%. That might vary year by year. In a Roth, I don't have a business partner. So if I have $1 million and it's a Roth, it's all of my money. If I want to take 100,000 out, I get to keep 100,000. It's all my money. And so I'm encouraging people to go through their retirement savings, not involving a business partner. And then for some people, they do need to, if they have, a lot of money in pre-tax and they want to safeguard against potential higher tax rates, they need to look at it and see, is it worthwhile to buy out my business partner, which, by the way, at the lowest rate that they've offered since the Great Depression, so that's not a bad deal. And my account, my business will probably be worth a lot more money 10 years from now than it is today. So they have to do the math on that opportunity and see if that makes sense for them or not.
Well, as you said in your book, wealth is a choice. That is a wise choice to make. Love to dovetail that kind of into your book. And what was the motivation behind writing it?
The book was something I wanted to get done. I was a dad of young kids. And I thought, if anything ever happened to me, God forbid, I don't know what would, but if anything ever happened to me, I'd have been in the business long enough. I've seen good business. I've seen bad business. I've seen good advice and bad advice. I've seen people make good decisions and bad decisions. And I want my kids to know what I think are the most important principles around money so that if I'm not around, they can read this book and they can be able to have what they need to ask good questions and make good decisions throughout their life with money. So that was the motivation. That's why I got it done when I got it done at the age I got it done.
Well, looking forward to an update, maybe.
The principles still apply, thankfully. They are time tested. But like I said, I find myself talking about a condensed version of that most of the time. So there will be a rewrite and it'll be focusing on the real meat of it.
There you go. Excellent. Well, I think that's very time fitting because everybody's attention span it keeps getting shorter and shorter
Yeah.
according to media, which is a good segue to my final question here. Don't want to take up everybody's attention span. At Harbor, we're firm believers in active management, though it is important to acknowledge that every financial expert has their own unique perspective. From your experience, what is your take on active management and where have you observed it making the most significant difference?
I tell you where in Roth accounts. I've seen it the most in Roth accounts, and I just looked at one last week. New client brought their statement in, and this account was very passively managed and by the underlying investments and the decisions that were happening over the years. There's hardly anything going on, and it hadn't grown in periods of time when it should have grown. I know 2022 was really tough, but it had been around for more than a decade. And that's such a wasted opportunity. I mean, the only advantage of a Roth is that it grows. That's the only advantage. You don't get a tax break for going in. The only benefit you get is it has to grow. And you want it to double and you want it to triple and maybe even quadruple at some point in your life. And that's the biggest mistake that I see. And it's a sad one because the thing that we have going for us the most in our pursuit of wealth is time. And if you let a lot of years go by that you neglect accounts so you don't have proper active role in it, then that you can't get the time back.
It is the most precious commodity we have. So with that said, another great segue. Last but not least, how can people find you if it's not on a mountain or on a bike or, on a trail?
www.jpstudinger.com. And if you want to find what I'm doing on a mountain or a trail, then just plug my name in. You'll see something probably.
We're going to go. I thank you for joining us today, but we're going to go to my favorite section of the podcast, which is 60 Seconds with James Studinger. Okay. And let me know when you're ready.
Good. All right.
What is your nickname?
Well, they called me Yooper in college.
Profession if you weren't in finance?
Inventor.
What's your hidden talent?
I cannot get lost in the woods.
Favorite view from all your hikes?
The top of Rainier.
What is the best professional advice you've ever received?
Work on things that you're naturally good at.
Biggest risk you've ever taken?
Unknowingly, Mount Rainier.
Bucket list travel destination?
I want to go to Italy with my wife.
What never fails to make you laugh?
My boys. Spending time with them. Goofy.
What's something you wish you were better at?
Scaling.
What piece of advice would you give to your younger self?
Chill out.
What's one question you think all clients should ask their financial advisor?
What can you do that's going to make things better?
Most rewarding part of your job?
Seeing clients go about their days and not be stressed about what's going on around the world.
Favorite way to get active?
Be outside.
Whether you're a seasoned advisor or just getting started, the Active Advisor, brought to you by Harbor Capital, offers professional insights for the financial advisor community. Visit us at harborcapital.com to learn more. And don't forget to subscribe to the Active Advisor on Apple, Spotify, Google Podcasts, or wherever you listen to podcasts to stay up to date on investment trends, tried and tested research methods, and what your industry peers are up to. From all of us at Harbor Capital, thanks for tuning in.
And now for important disclosures. This material is for informational purposes and is not intended to be relied upon as a forecast, research, or investment advice, and is not a recommendation, offer, or solicitation to buy or sell any securities or adopt any investment strategy. The opinions expressed are as of 3rd of May 2024 and are subject to change. The opinions expressed by the speakers do not necessarily represent the views of Harbor Capital Advisors, Inc. The information and opinions contained in this material are derived from proprietary and non-proprietary sources deemed by Harbor Capital Advisors, Inc. to be reliable and are not necessarily all-inclusive and are not guaranteed as to accuracy. This material may contain forward-looking information that is not purely historical in nature. Such information may include, among other things, projections and forecasts. There is no guarantee that any of these views will come to pass. This material may not be representative of the experience of other individuals. Reliance upon information in this material is at the sole discretion of the viewer. This material is not legal, tax, or accounting advice. Please consult with a qualified professional for this type of advice. Investing involves risk, including the risk of loss. Stock markets are volatile, and equity values can decline significantly in response to adverse issuer, political, regulatory, market, and economic conditions. Fixed income investments are affected by interest rate changes and the creditworthiness of issuers. As interest rates rise, the values of fixed income securities are likely to decrease. Specific companies and issuers are mentioned for educational purposes only and should not be deemed a recommendation to buy or sell any securities. Any companies mentioned do not necessarily represent current or future holdings of any investment products. Harbor Capital Advisors Inc. does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. This material is prepared by Harbor Capital Advisors Inc. Harbor Capital Advisors Inc. is not affiliated with JPStudinger Group. All trademarks or product names mentioned herein are the property of their respective owners. Copyright 2023 Harbor Capital Advisors Inc. All rights reserved.